Gentlemen, I've had quite the roller coaster of the past few days in and around the medical infrastructure of our fair country. So I'm just going to start off by asking, how's everyone feeling today? Feeling good?
I'm feeling
Just
great.
got my flu shot.
Oh, you got a flu shot?
Jake, you got a flu shot too?
I got my flu shot. Yeah, I feel even better than before.
Excellent. No, I got my flu shot, but a mere 3 hours ago. And at the same time, in the opposite arm, I got my second COVID booster, the bivalent one. So, one-stop shopping for all your flu and Omicron needs. I once read, and I don't know how truthful this is, but I found it compelling at the time. Once read that when you get a vaccine that has live virus in it, that has live virus as basically the active agent, it makes you more social. It makes you want to see people, go to bars, go to clubs, like hang out with people, because the virus is in you and the virus wants to spread. So it sort of takes over your brain for a second there and makes you want to hang out with people when maybe you wouldn't have been quite so extroverted previously. And ever since I've read that, like anytime I get a vaccine or even get sick with the virus, I'm like, do I want to hang out with people more? Like, it's just something I think about constantly now.
This is the virus's method of communication. It just gets you chatty.
Exactly. The virus
has nothing to say. It
wants to podcast.
Yeah. This podcast brought to you by the flu shot.
Exactly. Yeah. No. So episode 12 coming at you. Sponsored by episode 12 is sponsored by Pfizer, I guess. So I'm pretty sure I got a Pfizer vaccine. So we'll find out. This thing might take me down because the last vaccine I got, I was knocked out for a day or two. So fingers crossed.
Yeah, I can't imagine them working together. Like that just can't work. Like 2 vaccine shots in the same day. Like to me, it's just too much.
Just like there's like
there's just no way that works.
Did they offer one-stop shopping, or was this a request that you had? You requested it. Okay.
I did. I had a flu shot scheduled, and then I said to the nurse practitioner, "Hey, do you have that exciting new bivalent vaccine that I keep hearing about?" And they're like, as of this morning, we actually do. So I was like, great. Shots in arms. Let's do it.
I'm glad this isn't a medical advice podcast because so far I don't think our medical advice has been very, very appropriate.
Yeah, we should probably cut it out.
I can, however, also say this isn't medical advice, but I was hiking this past weekend and I believe I tore a ligament in a foot. So you can't see it for those of you watching at home, but my right foot is in a boot right now. And I got the boot because they wanted to preserve my use of hands while walking, so they didn't want to give me a cane or crutches. And I gotta say, the boot's working. I don't mind the boot.
They gave you a choice. You had another choice?
They were basically like, yeah, you could, because I mentioned crutches, like you could do crutches, but when you're walking around, you probably want use of your hands. So they just said, strap the boot on and continue to be able to fiddle with your phone or use keys, I guess.
Those boots aren't.
A chain could be a nice accessory, though.
Yeah, it could be.
I was thinking about that.
And those boots aren't cheap. They're like $400 or $500, aren't they?
So that's what I don't know yet. Because I went in, swiped my insurance card. We're going to find out.
No, that bill's doing it. Let me tell you, I got boots laying around my house, and they're not cheap. We reuse them.
I was gonna say, if you have boots plural. Why are you getting new boots?
Just because it's lost and you don't find it until after you buy a new boot, and so yeah, there's different size boots too, I guess. So.
All right. Well, this boot is getting pride of place on my mantle, so I never ever leave it. Never have to pay for another one.
The unexpected boot bill is sounding a whole lot like an unexpected capital gains distribution.
Oh,
not
Jake
loves it. The segue.
Jake was the host.
That was a lot better than I was going to think of.
I can't. I watch you. I would be an imposter.
Yeah.
Zach is our tried and true host.
Jake is being far too modest. He would be an excellent host with segues like that. And, I'd rather be lucky than good. So I'm not going to try to top that segue. We're just going to go right with that. Boots are like a surprise capital gain distribution with concomitant capital gains tax from a mutual fund. And that is the name of the game for this week's episode. We are talking all about mutual fund taxes. And while at first it might not seem like the sexiest of topics, I think our listeners might be pleasantly surprised. Our own Jim Kintowski has written an article all about mutual funds and their associated taxes and what to look out for and when to look out for them. It's up on the Baypoint site. But Jim, I'm just gonna sort of throw it to you first, because you know I don't think people necessarily think of mutual funds as something that will necessarily produce a taxable event. Maybe if they sell it at a capital gain because they bought it, it went up over the course of however many years that they owned it, and they sold it at the fund itself. They sold it at their long-term capital gains rate. That might be the obvious reason to people thinking about it, why it might realize a taxable event. But there are clearly other opportunities for taxes to be recognized and realized over the course of holding a mutual fund. Some that the taxpayer doesn't even have control over. So if you could just sort of start by walking us through the varieties of taxable events that come with owning mutual funds, I think that'd be really helpful.
Well, you did a great job there describing that. But yeah, mutual funds are great investment vehicles. They do a lot of things for you. They provide diversification. You can get exposure. The costs have come down. They can be low cost now, and so they're great ways to invest. And they can you do have to pay taxes on investments when you earn money, and mutual fund has a couple different ways you could end up having to pay taxes. And one of those ways is just like you described. You put a amount of money into a mutual fund, you hold it for a period of time, and you sell it, and you have to pay what's called capital gains appreciation, on that growth that you receive. But what you described and what people don't always consider is that you can be hit with taxes on from income generated from a mutual fund without actually selling that mutual fund. So it's something you have to be aware of and be concerned about in some situations. And so the way that happens is you put your money in a mutual fund, that money gets deployed and goes and buys different investments, and investments can be bought and sold within that mutual fund. And at the end of the year, those are tallied up and they are distributed to each investor proportionally based on the shares that you hold. So, so if a mutual fund has a lot of buying and selling going on within it, and it's been a good year, there could be some capital gains that were incurred inside that fund, which would be then distributed to you, which you would have to pay taxes on. So it can be a surprise hit sometimes where you didn't do anything, and yet you prepare your taxes, and all of a sudden you have this gain you have to pay tax on that you're unaware of. And we can get into some technical reasons why that can be greater at times than other times, because we'll get into that in a second. But first I want to touch on, there's also, you can pay taxes on dividends. So, you put your money into a mutual fund, and those underlying investments pay dividends. They get paid out of the mutual fund to you through dividend distributions. So that's another way you could end up paying taxes on dividends, which could be ordinary income tax, which is the tax that you pay as a individual taxpayer, or they could be qualified dividends, which switch a dividend tax from ordinary to capital gains tax. So there's a lot going on there. And with a mutual fund, you do lose a little control over when you have to pay taxes. So people have to be aware of that. So I'll stop there and let you guys hit me some questions, or we could debate it back and forth.
Well, thank you for that, Jim. That's really helpful. And I would be remiss if I did not take this opportunity for some cross-media advertising. You mentioned dividends. Early in our series run, we had a great episode, I believe entitled Everything You Always Wanted to Know About Dividends But Were Afraid to Ask. So for those who want to do a deep dive into dividends, there's your opportunity.
That's it.
I was gonna, kind of add, Jim. I think one of the points you were making, around mutual funds and how they work, is really pointing to their nature as pass-through investments. And so if you own shares of a mutual fund, you own shares of essentially kind of a managed portfolio, and you are, as an owner of that, all of the intaxable events that portfolio has are in some shape or form passed through to you as the shareholder. So if the portfolio, the mutual fund itself, receives income from the dividend income from the investments that it owns within the fund itself, that's going to get passed on to you since it's a pass-through investment, one way or another. And if that mutual fund is, buying and selling some of the investments that have gone up in value, then it's accruing and accumulating capital gains. And those capital gains, they've got to come out and they've got to get passed on to the shareholders because, again, it's a pass-through investment.
Yeah, pass-through is a great way to describe that. Definitely.
Jim, I just want to dig in a little deeper when it comes to the timing of these taxable events as a result of the mutual fund selling off appreciated underlying stock for the mutual fund, or paying out dividends, because very few people enjoy the act of paying taxes, but far fewer than that enjoy the act of paying taxes that come as a surprise.
Sure.
So when a mutual fund that you might own a portion of sells or realizes a taxable event, when will you, the mutual fund owner, find out about that or see that? Will that be withheld for you from the mutual fund by either the fund company or the custodian where you hold your fund, or come tax season, are you going to basically get slapped with a bill because the mutual fund manager made some choices that you weren't privy to and had no control over?
Yeah, it's a really good question. So typically you find out when you receive your 1099 from the mutual fund company. Well, that's one way you're officially notified. You'll receive a 1099 from the mutual fund company. Those are typically sent out at the January 31, and you receive it, and it determines how much income, capital gains, distributions you received. But you could also find out, you receive those dividends or capital gains. They could be paid to you. They could be inside of your investment account. You can actually see the transactions happening inside of the account. So if a mutual fund pays $20 in capital gains, that shows up in your account, and that either gets reinvested or shows up in cash. So if you're paying close attention to the income generated by your portfolio, you can see what's happening throughout the year, and you can take note of it. But typically, most people don't really pay attention until the end of the year when they receive that 1099 that comes in the mail.
And paying attention is really the name of the game. And in some cases, depending on the mutual fund company or the investment company that's providing the fund, I think just one of your points in the article, Jim, is there are kind of tax conscious fund managers and there are tax kind of unconscious fund managers or funds, if you will. And so, I mean, I think if you are of the mind to want to pay attention to find out, okay, kind of stay true to how much taxable income you're going to have for the year, and especially at the end of the year with these capital gains distributions that are coming from mutual funds, I think it becomes a lot easier to pay attention if you are working with and using funds provided by a more tax conscious fund manager. Those investment companies are going to be making their best effort to provide estimates for those year-end distributions. Those are oftentimes, depending on the year, the largest income events that you'll get from the mutual fund itself. So those tax-conscious managers and investment companies are being proactive, but it still can be easy to miss as an investor if you're not attuned to the availability of these estimates coming out, or even attuned to the fact that you're going to have potential for a large income event at the end of the year.
So paying attention is a really good thing throughout during the year, but I would also add, and I'm going to ask you some follow-up questions on that, Jake, is how we can figure that out. But actually, before you purchase a mutual fund, paying attention to the type of mutual fund. You mentioned like a fund that is maybe active versus passive, or doesn't buy and sell as much. How would I, as an investor, determine what that fund? How would I find that fund? What would I look for in terms of when I'm making that purchase?
This gets kind of exciting and down into the weeds a little bit, where, as an investor, if you're out there kind of doing it yourself, you're confronted with a host of choices. Okay, how do I invest my money? Do I purchase individual investments, individual stocks, individual bonds, or do I purchase kind of pooled investment vehicles like an exchange traded fund or a mutual fund? And for some folks, I think the kind of attention stops there, and you say, okay, I've got these three kind of categories or three strategies I can take to invest my money. And so, in a way, in categorizing your investment choices based on the vehicle, it's easy to lose sight of the details that are present and can distinguish between different kind of flavors of the same investment vehicle. So, mutual funds are not all alike. They're very much different. They come in 1,000 different flavors. And one way, I think, Jim, you're kind of pointing out this distinction between mutual funds that are more actively managed, so buying and selling investments on a much more frequent basis for any number of reasons. Could be a rules-based reason. It could be a tactical or predictive reason. So these are kind of actively managed funds versus passive funds that buy and hold a certain segment of the market, usually categorized by an index. So a list of companies kind of all meet a certain criteria. So one kind of quick and easy way to distinguish between the types of mutual funds that you're looking at is going to be something called the turnover ratio. So if you're an investor looking at the mutual funds and you kind of want to understand, okay, what kind of tax impact might I get from these? How are these managed? The turnover ratio can be a good indication, not the only indication, and it's not always the most accurate. And we can talk about the reasons why, but it can be a good starting point as an indication for what kind of income you're going to get. Higher the turnover ratio, the more buying and selling is happening in the fund. And just as an example, a mutual fund with a turnover ratio of 100% swaps out all of the investments within the fund within a calendar year. A mutual fund with a turnover ratio of 4% is only selling out 4% of the investments within the fund itself within any given year. You can see turnover ratios over 100%. That's an indication of a whole lot of buying and selling. And I'll just use that as a point to say, when we are distinguishing between turnover ratios in stock funds and bond funds, it's not always kind of the same active passive distinction. So bond funds, I'll just suffice to say, can sometimes have much higher turnover ratios, but that's not necessarily a clear indication of active management.
You got it, Zach. That's what I was looking for, was turnover ratio.
Yeah, and just on the subject of bond funds, just because I know bonds are very much I feel like having a moment in popular consciousness, and certainly in the news media that reports on the financial markets. Would that turnover in the bond ratio not due to active management be due to perhaps bonds reaching maturity and reinvesting the capital that's realized?
That's exactly right.
Or is there something else at play?
Yeah. Yep, that would be it. So when a bond matures, it's like it's selling, and so that would factor into the turnover ratio. You got it.
Gotcha. And just for listeners who are looking for something actionable, like when they think about turnover ratios, when they're considering the vast array of mutual funds, and there are many mutual funds that one could purchase. What's is there a benchmark turnover ratio that one might look for to say, okay, below this number, below X percent, I know that this is probably a tax conscious manager who's hoping to keep those potential capital gains distributions at a minimum?
Yeah, I mean, I don't know. Yeah, I was going to jump on that.
Yeah, go ahead.
Usually shoot for less than 10. Usually shoot for less than 10%. As an indication of more of a passive approach. It's going to be a whole lot less turnover and a much more active approach. You're going to be probably nearing that 100% threshold. It's definitely above 50, probably getting closer to 100. And you can see, like I said earlier, turnover ratios over 100%.
Yeah, and so I would agree with you.
And at that point, if we're
around 10%, but there's also, and again, we would get way in the weeds, but different types of mutual funds and different asset classes might have a little bit higher turnover ratio than other asset classes. So you can't really specifically dial it into a specific percentage, because even good mutual funds that have low turnover ratios may actually have a little bit higher turnover ratio because the nature of what they're investing in.
Yeah, and if it's truly an index mutual fund, I mean, it needs to have a turnover that the index had itself. So if you see kind of a quasi-index fund that has a higher than you would expect, turnover ratio, that can be maybe an indication there's something else going on in the management of the fund, and it's not necessarily kind of a true index fund.
Now, given that taxable events are almost entirely impossible to completely mitigate, though there are certain strategies, depending on the kind of fund that you own, that can reduce that likelihood. What are good options available to investors, or investing strategies that investors can take advantage of that reduce tax liability in a given year when they're holding mutual funds? I know it's sort of a wide question, so I'm interested to hear what both of you think.
Yeah, so it's a really good question, and that's something that you should also pay attention to. That could be the name of our episode today. Pay
Pay
attention to
attention.
taxes, right? Um, so it's we're in a market right now where stocks essentially have been down for the year, and so what happens is you can actually recognize losses from an investment. So if you put money in a mutual fund and that mutual fund actually goes down in value, what you can do is you can sell that mutual fund and recognize that loss, put it on your tax return, and use that loss to offset future capital gain distributions that come out of a mutual fund. You have to be careful with this because you can't reinvest in that same mutual fund 31 days out. So you got to be careful. You can buy something different and stay in the market, but you can tax loss harvest, which will avoid taxes in a lot of cases. One point before I let Jake go on this question too is just something you got to pay attention to is sometimes mutual funds have what's called built up gains inside of them. So you might be putting into your money into a mutual fund which has accumulated gains over a really long period of time. So some of these passive or lower turnover mutual funds that were started a long time ago, have built up gains inside of that fund. And when you put your money in there, you're essentially buying into those gains. And I'm going to relate it to something we're going through now. Like even though the market's going down, and this has happened to people, and this is the surprise that sort of hits, even though the market is going down in nature, people sometimes get anxious, as we all know, and they might liquidate their mutual funds. And so when those liquidations happen, the mutual funds have to sell products, investments inside of that fund, which then can trigger capital gains. So you can almost be in a really difficult situation where your portfolio's lost money, but the mutual funds, because they had these built up gains inside of them, actually distribute gains to you at the end of the year. So that's really one reason to make sure you're paying attention and recognizing losses, so that in the event that one of these mutual funds you've owned for a long period of time, people liquidate it, that they spit out capital gains to you, you can use them to offset those gains. So that was a mouthful. I know I'm gonna let Jake take it from here on other ways to avoid.
Jake, before you answer the same question that I posed to Jim, I just want to pause a moment on what I think is a really sort of key and fascinating part of that answer. The idea that in a down market or a bear market that such as the one that we're experiencing and that we're all feeling right now, you could, if you're a buy and hold investor and you're holding onto a mutual fund and you're willing to sort of ride out the vicissitudes of the market. It's down now, but it will, you have the assumption that it will be up again at some point in the future. You hold your mutual fund. It's fascinating that you can still be on the hook for capital gains realized within your mutual fund if you do not sell, purely because there are other owners of that same mutual fund who are feeling sufficiently scared or concerned that they sell their mutual fund, triggering those gains to be distributed to everyone who holds it in a pro rata fashion. That you can sort of be on the hook even if you stay the course because someone else chose not to.
Yeah, I think there's kind of get into the weeds even a little bit further in terms of I think just that theme of paying attention, and not all mutual funds are the same, and not all investment companies that manage mutual funds kind of have the same approach, and they attract different kinds of investors. And so you can, if you're looking at mutual funds, you can obtain data on the flows into and out of the fund to get a sense for, okay, are a whole lot of the investors in this particular fund kind of jumping ship at just the wrong moment? Or, some investment companies, or do you have kind of net inflows? Are people buying in when the market's at kind of a low point? And you can, instead of looking at fund flows, you can kind of pay attention to the cash balance in the allocation for the fund. If you're looking at a fund to have some indication for, okay, are the fund managers of this mutual fund kind of preparing for, this kind of this fund flow out, these redemptions that then if you're a buy and hold investor, you kind of, like you said, Zach, you're kind of on the hook for the actions of the other investors that you were, pooled with. So I think that's kind of an important, consideration if you're looking around. There are things to pay attention to, and you can kind of do some research around. I think just another point, which is interesting. I think, Jim, you're kind of, speaking to this a little bit, but these kind of unexpected income events, and as a result of actions that you had really no part of, one of those in the built-up gains in the fund. One of those that we have seen is the sale of a mutual fund from one investment company to another. And when the mutual fund is sold from one investment company to another, all the capital gains have to be discharged in that process. And so investors who hold a fund that's going to, be sold, they'll typically get notification that this is going to happen, kind of give you some opportunity to plan around that. But you kind of end up in a situation where if you're not paying attention to that, you end up with a much larger kind of capital gains distribution at the end of the year than you ever would have expected as a result of that.
Did that not? I'm not going to mention any names here, but I believe that happened to a very large, low turnover type mutual fund company. I think it was last year, 2021 or 2020. And there was a internal change like that was made that was sort of overlooked, which created a very large capital gain distribution. Is that something that you're referring to there?
Yeah, I think something very similar to that. Maybe thinking of the same thing.
Yeah.
But we're all pointing fingers here, today. But I think it's just back to that thing. I think it's a nice theme that's emerged, is kind of just paying attention. And so, as an investor, you're going to get a lot of information that's sent to you about your mutual funds. You get your prospectuses each year and all this kind of thing. And it's something where it's easy to not want to pay attention to it or not pay attention to it. There's a lot of that information that you don't really need to pay attention to. So I think it really boils down to kind of having some experience around what you need to be paying attention to and what you can kind of let go.
Yeah.
But Zach, I think by this point, I've already kind of forgotten what your question was, but I do want to touch on just a couple of things, which, and Jim, you probably mentioned this kind of first thing, but I just want to reiterate the point. When we're talking about mutual funds and taxes, we're really focused on and talking about holding the investments, the mutual funds, in a taxable account,
Sure.
after tax brokerage type of account,
Yeah.
not a retirement account. And so this one of the things you touched on in the article, Jim, is a way to kind of help mitigate or manage taxes from mutual funds is to own them in retirement accounts. A lot of what we're talking about in terms of managing and planning for these taxable events is much more relevant to owning the investments in a taxable account. And I did just want to kind of bridge that to just the whole idea of what we call asset location. And it's the idea of owning certain categories or types of investments. They could all be owned within mutual funds, but owning certain categories of investments in certain types of accounts for tax advantages or for tax reasons. And I think one of the kind of typical, or kind of quintessential examples is, kind of own your bonds or own your bond mutual funds in your qualified, retirement plans or IRAs, because those bonds are going to pay you interest, and interest is taxable as ordinary income. So you don't necessarily want to have your investments in your taxable account just churning out, taxable income that's taxable at your highest rate. There could be, I think this is really the ultimate point I want to make, there's always a contextual reason to kind of switch things up from the textbook answer. So you may have a need to draw from the taxable account, so you may want to go ahead and position some bonds in there as opposed to stocks. But I did want to touch on that idea of asset location, and Jim, you can probably build on that idea as well.
Well, thanks for picking me up there. That was the question Zach asked, like, how do you avoid paying taxes there? And that's really another way to do it is only different asset classes or different investments in different types of accounts. And even if we said, look, let's say you want to buy a high turnover, mutual fund because of whatever reason, like you like the manager or you like how they're investing and you like the fact that they're buying and selling. That's not necessarily our philosophy, but let's say you like that. You may want to consider holding that in an account where taxes are deferred, or a Roth IRA where those taxes are grow tax free, so you're not getting hit with those distributions. It's a great way to plan and manage your taxes is by holding different things, different investments in different accounts, and that's why you should have a taxable account. You should have an IRA account. You should have a Roth IRA account. It gives you a lot of flexibility in terms of where to hold investments and manage your tax liability.
And I'm just going to make this comment because I think for any of our listeners out there who are listening to us talk about mutual funds and taxable accounts, some of them may be asking, okay, what about ETFs? And this episode is definitely not about the difference between ETFs and mutual funds, but I think I do just want to point out that ETFs can provide some tax advantages over mutual funds, particularly if they're held in taxable accounts. So, I don't think the message here today is, always own mutual funds and always own them in a taxable account. There can be plenty of very valid and appropriate reasons to own mutual funds and own mutual funds in a taxable account. Of course, exchange shared funds exist and those tax benefits exist. And I think it's just situation dependent on what's most appropriate.
I was going to say, you're sort of queuing up the next few episodes. I feel, we could do like a whole series of episodes on the concept of asset location and, what assets should be held in what sorts of accounts. And I think we are also, given that we're on the subject of mutual funds, due for an episode detailing the similarities and differences between mutual funds and ETFs or exchange traded funds, which Jake just mentioned. But until such time, I think we have pretty much run out the clock on our time together today, unfortunately.
Are you giving us the boot?
Yeah, exactly. Yeah, I'm giving. Well, it depends on what insurance says. I'm not sure if I'll be in a position to just give away boots. But I'll let you know once my my monthly bill comes. But we will leave you with the moral of this episode, which is, of course, pay attention. And until next time, I'm Zach Frank. I was joined by Jake Sadler and Jim Kintowski, and we will see you next week, everyone.
Thank you.
Thanks, everybody.
See you, Zach. See you, Jake.